One of the things that's always important to us is to make sure our whole staff is watching the markets and trying to be as intelligent as we can to predict what might happen in the future. How do we get in front of making the best decisions, and how do we arm ourselves and our clients with the best information to make those decisions and to make comfortable decisions? And the last few weeks, we've had a lot of what we'll call positive signals. We had the Fed come out and say that they're likely going to do three rate cuts starting in June, which was exciting news. Stock markets rallied. But as of the last 2 days, there's been some strong economic readings, one in particular being the manufacturing data, which was the strongest reading since September of last year. In layman's terms, what that means is what was a battered manufacturing sector seems to be recovering. And because that's good news for the economy, it could be bad news for interest rates. And now, of course, we have headlines saying, well, maybe the Fed won't cut rates in June. Do we know for a fact? Of course we don't know. So we don't take this and try to predict what's going to happen, but what we can do is deliver the information in a way that's digestible for all of you so we can all be thinking about this. And the reason it's important is we've never seen so many inquiries for home equity lines of credit, and people will be shocked about this data, but 30% of mortgage applications right now are for refinances. And we know everyone's trying to hold on to those 2-3% rates from COVID, but there are times when it makes sense to get rid of that rate and to sort of reposition yourself for the future. Even though the rates are going to be higher, we're seeing the cash utilization that our clients are doing, whether they're investing that money or buying more property. Even their financial planners have reviewed some of these strategies we put together and agree that it's a smart thing to do. Now, of course, the only way to determine that is to get a consultation, have someone ask you the right questions, and make sure they put you down the right path. But we thought it would be something worthy of going over because we are seeing a lot of inquiries for it. And if it's something you're even thinking about, we've got credit card rates at an all-time high over 20%. So even if a mortgage rate is mid-6s, 7%, that's a heck of a lot better than your credit card payment. And by the way, in most cases, that interest on a home loan is tax deductible. So just things to keep us all thinking about so we can make the best decisions moving forward in this crazy market, and we'll do our best to continue to help you navigate it.